Welcome to this week's Market Update, where we review the key developments that shaped markets, highlight what drove our recent performance, and look ahead to important events on the horizon. Let's start with what moved markets this past week. We saw some interesting dynamics play out, with the Federal Reserve showing signs of internal debate while economic data painted a mixed picture. The big story was dissent within the Federal Reserve. For the first time in this tightening cycle, we saw two Fed governors break ranks and vote for a rate cut. Governors Bowman and Waller made the case that while inflation from tariffs is likely temporary, the risks to employment are real and growing. This internal debate suggests we could be approaching a turning point in monetary policy, which could be positive news for both stock and bond investors who've been patient throughout this period of higher rates. Treasury yields dropped notably after July's employment report came in weaker than expected. The economy added just 73,000 jobs versus expectations of 100,000, and the 10-year Treasury yield fell by more than 6 basis points. While the headline missed estimates, this move in bonds actually creates opportunities. It shows markets are functioning well and efficiently pricing in new information. For diversified portfolios, this environment reinforces why we maintain balanced allocations that can provide stability through different market conditions. We also saw significant volatility in stock futures, with the Dow dropping over 450 points as markets digested both the weak jobs data and new tariff announcements. While the immediate reaction was sharp, history tells us that such volatility often creates opportunities for patient, long-term investors. Markets have consistently rewarded those who maintain their strategy during uncertain times. Quality companies with strong fundamentals tend to demonstrate their resilience in these environments, which is exactly why we focus on owning businesses that can weather various economic conditions. Now let's take a look at what drove our performance over the past week and why we remain confident in our positioning. NVIDIA led our holdings with a 5.1% gain last week, continuing its remarkable run as the leader in artificial intelligence computing. The company's graphic processors remain in high demand for major tech companies building AI infrastructure. What makes NVIDIA compelling isn't just the current demand, it's their dominant position in AI accelerators, the critical technology powering everything from ChatGPT to autonomous vehicles. With new supply agreements extending well into 2026, we see continued momentum ahead. The information technology sector was our strongest performer, with synchronized gains across cloud computing, semiconductors, and enterprise software. Our tech holdings, including Microsoft, NVIDIA, and Broadcom, all posted gains exceeding 4% as quarterly earnings validated the sector's strength. These companies benefit from powerful long-term trends: artificial intelligence adoption, cloud infrastructure investment, and digital transformation across every industry. While valuations have expanded, the accelerating growth and improving margins justify our continued conviction in market leaders with strong competitive positions. Our quality strategy also delivered positive returns, showing how companies with strong fundamentals perform well across different conditions. The approach focuses on businesses with sustainable advantages, strong balance sheets, and consistent cash flow. Microsoft led this group with over 5% returns, while automatic data processing also contributed gains. Even when some traditional quality names face short-term headwinds, we maintain conviction because history shows these companies with pricing power and essential services demonstrate their value over time. Looking ahead, here are the key events we're monitoring that could shape markets in the coming week. On Wednesday at 2 p.m. Eastern, the Federal Reserve will release minutes from its July meeting. With two Fed governors recently dissenting in favor of rate cuts, these detailed notes will provide crucial insights into the Fed's thinking. Investors will be looking for clues about when rate cuts might begin and how concerned officials are about slowing job growth versus inflation. These minutes should help markets better understand the path ahead for monetary policy. Thursday morning brings the weekly jobless claims report, offering a timely snapshot of employment conditions. This data has become increasingly important as recent reports show unemployed workers are taking longer to find new jobs than at any point since 2021. A steady number would signal continued resilience, while any unexpected increase could indicate trade uncertainties are affecting hiring decisions. We're also watching earnings from major banks, including JP Chase, Wells Fargo, and Bank of America. These financial institutions serve as economic barometers, revealing trends in consumer spending, business borrowing, and investment activity. Recent results have shown strength in investment banking and trading, suggesting that corporate America remains active despite trade concerns. Bank earnings often provide early signals about economic shifts, making them essential for understanding where we're headed. As always, we remain focused on what matters most, helping you achieve your long-term financial goals through disciplined investing and thoughtful portfolio management. Thanks for joining us, and we'll see you next week.